because all the trades has to happen, take the data from those sites only. We have to review the data, we have to check the data, we have to analyze the data from those websites only. So that is, those two sites are basically the encyclopedia of trading and investments.
Okay. And sir, you had sent me a link of that Kotak Demat account.
You can.
I I got it done, sir, and I mean, they told it will take some time for verification.
1 to 2 days they will open it and they will share you the details, username and password.
Okay, sir.
1 second. So do you know about the finance rules?
Finance rules, no, sir. It was there in that NSE. This one.
No, it is not there in that site. But there are certain rules that you should remember. I'll just share my screen. You can note down those things because it is important to remember that.
Sir.
Okay. So these are basically the 9 personal finance rules that everyone should know and everyone should try to follow it. Right?
Okay, sir.
Whether as a child or as an adult or whoever it is, he should try to follow these rules, right? So first rule is about rule of 72. So what rule of 72 says that how many years it will take for your money to get double, right? In how many years your money will be doubled based on the interest rate or based on the return you will get from different asset class, whether you are getting it from FD or you are getting from stocks or you are getting from mutual funds, whatever it is. So the rule of 72 says that the formula is 72 divided by the interest rate. Okay. So means if a specific asset is giving you a 8% of interest rate per year, then it will be like 72 divided by 8. And how much it will be? 8 9 is 72, right? So 9 years it will take to double that money. If you have invested 1 lakh in a fixed,
to double that. Okay.
So 1 lakh will become 2 lakhs in 9 years. Okay. So same thing if you see from the stocks perspective, normally the minimal return is around 12 to 14%, which is the safest return every year from the stocks. And if you think about the mutual funds like that, then in that case you can consider like 72 divided by 12. So that will be around 6 years. So your money will be doubled in 6 years. So this is how you can calculate, based on your goal and target, you can calculate how much your money will be after certain number of years, right?
Okay.
Let's say after 4 years you plan to have like 5 lakhs of money, or some goal is there in your mind, and so based on that you have to start the investing based on the return you are getting from that asset class. So this is how you have to plan.
So the current rate is 12 to 14%. Sir.
Normally, which I have seen based on the historical data and all, from past 20, 25, 30 years like that, I have seen that the mutual funds or the stocks which are large cap, right? We spoke about the blue chip stocks now. So those stocks normally give 12 to 14% return per year like that. Okay. So to remember this, whenever you are planning to find your goal or target, so you can use this formula to calculate those things.
Okay, sir.
Okay. Second rule is rule of 70. So this rule of 70 says that based on your inflation, how soon or how long it will take to half your money. So this rule was to double your money, right? So and this rule is like
Half your
will take to half your money, right? Because based on the inflation and all, right? So like rule of 70 means 70 divided by the interest rate means if you are investing in a FD gives around how much interest? 6 to 7%, right?
yeah.
So you have to divide 70 by 60 and based on that you will get the number of years in which your money will become half. Half means the money will remain same only but the value of money will become half, right? Let's say the value of money 5 lakhs right now, okay? And you have invested in a FD which is giving 6% of interest every year, right? So 70 divided by 60, how much it will come?
Around 9 something.
9 years, right?
Yeah.
Not 9 years. Actually, it is 6 now.
Okay.
11.5 or something like 12, right? It will come like that. So in 12 years, the value of 5 lakhs will become 2.5 lakhs. Means whenever you are going to spend in the market, based on the inflation, it will, let's say something you are, let's say you want to buy a flat right now, which is costing around 20 lakhs, right? Okay. Then after 11.5 years, that flat will cost you 40 lakhs. The value is increasing in terms of asset, but in terms of money, the value will decrease.
Okay.
You have to spend more actually to buy, if you want to buy anything like asset or flat or if you want to see the fees structure, like all those things, the money, the value of money will become half.
Okay.
You have any idea about inflation?
A bit, sir. I mean, like inflation is where the currency price goes top, and so does all the economic things go top, like groceries, all of it also.
So inflation is basically a general increase in price and a fall in because these two are inversely proportional. Once the inflation goes, the value of money will decrease like that, right? So here also we are considering the inflation in the formula. It is not showing you, but based on the inflation, this will decrease your money, the value of money, right?
Yes, sir.
Fine, this is clear now. Any doubt in this?
I got that rule of 72 perfectly, sir, but not this rule of 70.
Yeah, one second. Let me explain you with an example. One second. Okay, so let's say right now you are spending 1,000 rupees per day on some kind of items like grocery or like to buy something else, right? Like daily items. Okay, so this rule says that after that much of years, you have to spend 2,000 rupees per day because based on the inflation will increase, right? So based on that, you should be spending double of that money after 10 years, 5 years or 10 years. So that means the value of money is decreased, right?
Yes, sir.
Earlier you were using 1,000 rupees to buy the same items and after certain years you are using 2,000 rupees to buy the similar kind of items, right?
Yes.
So that is why you should invest in a place wherein you are getting a return more than inflation.
Okay, sir. Got it.
So let's say currently if the inflation price is let's say 6 to 7%, then you should be investing in an asset which is giving the return more than that. Then the value of money will not decrease. But if you are investing in an asset which is giving you less than inflation, then the value of money will decrease. So it works like that.
Okay.
Now is it clear or still you have some doubt with this?
Yes, sir. I got it.
Right. So it is basically like both the rules you should remember it. Okay.
Okay.
Third rule is 4% of withdrawal rule. So this says that withdrawing 4% of your retirement savings annually, right? Annual withdrawal should not be more than 4% of total savings. So let's say you have some lump sum money of 50 lakhs, okay, and the person want to retire. Once the person retires, he doesn't have any other income, right? So he want to generate some income from this corpus only, right? Because if he doesn't invest, then the value of the money will decrease, right? So
Yes, sir.
he has to invest somewhere wherein he is getting more rate of return. So let's say he has invested 50 lakhs in some mutual fund which is giving 12 to 4% of return, okay, per year. So the maximum money he can withdraw every year is 4% of 50 lakhs.
Okay.
Right. So if he withdraws 4% of this money, then your return will reduce, right? Because here you are getting 14%, and now you are withdrawing 4%. Now your return will reduce to 10%, approximately like that, right? So you should not withdraw more than 4%. So this rule says like that. So 4% will be approximately 2 lakhs, right?
Okay.
Right. Next is 100 minus age rule. So
What if we more than 4%, sir?
you can withdraw it. That is fine, but the money will not increase like that because you are withdrawing, let's say 10%. Then your money will grow only at the rate of 4%.
Which is very less. Okay.
It is very less, right?
Okay. So
You
withdraw
are
4%.
because you are not able to beat the inflation at 4%, right?
Okay.
Inflation is 7%, right?
Okay. Okay. Got it.
So that is why this rule says that you can withdraw only 4% of 4% part of that income
Annually.
right?
Yes, sir.
Okay. So the next rule is 100 minus age rule. So this rule says you like how much percentage you should invest in equity. So what is equity? Stocks, stock market, mutual fund, like that, right? So there are two types of things. One is equity, other is debt. So debt is like basically the government bonds or corporate bonds in which the risk is very less. So they are giving you a specific fixed rate of return like FD, right? 6%, 7% or 8% like that. But equity returns are based on the market condition. If the market goes up, equity will give you more return. If the market goes down, equity will give you less return. So it is totally based on the risk and reward thing, right? So this rule says that based on your age, you should invest certain percentage in equity and remaining percentage you should invest debt fund, right? So let's say this says that 100 minus age, okay? So let's say your age is 25 years. So 100 minus 5, 70. So whatever money you want to invest in the market, 75% of that money should go in stocks or equity.
Okay.
Let's say you want to invest 1 lakh. So 75,000 should go in equity and remaining 25% you can put it in debt fund or savings account or FD, something like that.
Debt fund means we are giving debt for.
No, it's not like that. Debt fund means they have certain kind of bonds, government bonds, corporate bonds, and all those things. It is similar to fixed deposits.
Okay, they'll give you a certain rate of interest every year.
So that I will show you later, like how many types of bonds are there. but you can just now for consider like a certain percentage. Neha, वो चाबी दे देना. Okay, this is clear.
Yes, sir.
So let's say if my age is 45 years, right? So 100 minus 45, 55%. I should not invest more than 55% in equity.
Okay.
Right. So this rule you can remember, because see, the lesser is your age, the more risk you can take. The more is your age, you should take less risk, because as I told you that stocks are very risky. It is based on the return is based on the market condition. If the stock market goes up, you will get good return. If the stock market goes down, you will get less return, right? So the risk will be more.
Okay.
So based on these rules, some people will do financial planning. See, if some persons will come, they want to do financial planning, right? So we have to use this rule also while doing the financial planning of a person.
Okay.
Right. Then is 10-5-3 rule. So this rule says that 10% of equity provides expected returns for different asset classes, right? So this says that 10% of the equity, 10% of return from equity, 5% return from debts, and 3% from the saving account. So this is what the minimum returns you should get it, right? So this rule says that. But I am talking about 12 to 14%. I was talking about 12 to 14%, right?
Yes, sir.
So that is a maximum, but this 10% is a benchmark.
Okay.
Yeah. So this 50-30-20 rules. So this is like 50% you should spend on needs, 30% on wants, and 20% on savings. Next is 6x emergency rule. This is basically for the emergency fund. How much fund you should save it for your this thing, right? So this 6x means 6 times your salary. Whatever money you are earning from salary or from anywhere, you should have the 6x of that particular amount in your emergency fund. Okay.
6 times of that salary amount in your savings fund.
In your emergency fund.
Emergency fund. Okay.
So that means 6 months at least.
Okay.
Indirectly, you can say that 6 months of the fund. Let's say if you are earning 50K per month, right? Then you should have 50 into 6. 3 lakhs in your emergency fund.
Okay.
Then is EMI rule. So this rule says that keep loan EMI under 40% of your income.
Okay.
Some people will take more percentage of EMI and they don't follow this kind of rule, right? So based on this rule, you should try to take the EMI considering this rule. Let's say your income is 1 lakh, so your EMI should not exceed 40K.
40,000. Okay.
Life insurance rule. So this is get at least 10 to 15% coverage of your annual income. If your annual income is 10 lakhs, then you should take a insurance of 10 lakhs into minimum of 10 years. 10 lakh into 10.
Okay.
So these things are very important. Once you start your job or once you start your career, you should remember these. And these rules will keep on coming in your life once you start your career.
Okay. Sir, and regarding that emergency rule, initially when we start earning, how will we have 6x? I mean, 6 into
6 times. So let's say, see, you can do it slowly, right? Once you start your job, after 1 year you can try to do it, right?
Okay.
Let's say at the start of career you started earning 50K, okay, 50K per month. So emergency rule says that 50 into 6, 3 lakhs, right? So you can start saving some money from the start, like 2,000, 3,000, like that, slowly. And after 2 or 3 years, you should have that much of fund with you.
Okay.
Like that. So these rules will help you from the starting of your career till your retirement age.
Okay.
Clear? Any doubt in any of the rules?
Sir, I'm not sure of the 10-5-3 rule, sir.
So that is mostly not used, but this provides expected return. So this is like a benchmark they are talking about. See, whenever you keep money in savings account, you will get 3% of return. Whenever you're keeping the fund in debt funds, they will give you minimum 5% of return. And if you are keeping in equity, you should expect minimum 10% of return. So this is a benchmark they are talking about.
Okay. Minimum which you're supposed to get back.
You should get it. See, you should not be investing in such equity wherein you are getting the return less than 10%.
Okay, sir.
Fine.
Got it.
Let's come back to our slides. This is clear. Okay. So now we have stock markets. In the stock market, we have basically three types of conditions. Okay, there are three types of conditions in stock market. One is called as bull market,
Okay.
bear market,
Okay.
and there is one more which is called as sideways market, which is basically a mix of both bull and bear.
Okay.
Okay, so bull market means that the market will keep on rising, right? This is called bull market, or we call it as a uptrend also. Sometimes we call it as a uptrend also. Okay. Bear market is something like which is continuously keeps on going. This is called